Good morning. In the last counseling session, we were discussing the valuation of securities. In this connection, we had discussed the concept of present value as well as the future value. Now, we are going to discuss the valuation of different types of securities. First of all, debt securities, valuation of bonds. Debt securities issued by governments, government and quasi-government organizations, and private business firms are fixed income securities. Bonds and debentures are the most common examples. The intrinsic value of a bond or debenture is equal to the present value of its expected cash flows. The coupon interest payments and the principal repayment are known, and the present value is determined by discounting these future payments from the issuer at an appropriate discount rate or market yield. Or in other words, we have to calculate the present value of all the payments, the sum of the present value of all the payments. The valuation of a bond involves determining its fair market value based on various factors, such as the bond's coupon rate, maturity date, and credit rating. The most common method used to value a bond is the present value method, which calculates the value of the bond based on its future cash flows discounted back to their present value. The present value of a bond is the sum of the present value of its future cash flows, which include coupon payments and the final payment of the principal at maturity. To calculate the present value of each cash flow, the cash flow is discounted back to its present value using a discount rate that reflects the bond's risk. The formula for calculating the present value of a bond is as follows. Present value equal to C upon 1 plus R raised to 1 means after year 1, what is the coupon rate? And that is discounted to the present time. C upon 1 plus R raised to 2, that is after 2 years, what is the coupon rate? That has been discounted, and so on. C 1 plus R raised to N plus F upon 1 plus R raised to N. F is the face value or principal payment at maturity. The discount rate used to value a bond depends on the bond's risk. Generally, the higher the risk of default, the higher the discount rate used to value the bond. Bond valuation is important for investors who need to know the fair value of a bond before making investment decisions. A bond that is undervalued may be a good investment opportunity, while an overvalued bond may not provide a good return on investment. Now, Valuation of preference shares. Preference shares are a hybrid security, means they have some features of bonds and some features of equity shares. Theoretically, preference shares are considered a perpetual security, but there are convertible, callable, redeemable, and other similar features which enables issuers to terminate them within a finite time horizon. In the case of redeemable preference shares, legal mandates require creation of redemption sinking funds and their earmarked investments to ensure funds for repayment. Preference dividends are specified like bonds. This has to be done because they rank prior to equity shares for dividends. However, specification does not imply obligation. Failure to comply with which may amount to default. Several preference issues are cumulative, where dividends accumulate over time and equity dividends require clearance of preference shares first. Preference shares are less risky than equity because their dividends are specified and all areas must be paid before equity holders get dividends. They are, however, more risky than bonds because the latter enjoy priority in payment and in liquidation. Bonds are secured also and enjoy protection of principal, which is ordinarily not available to preference shares. Investors require returns on preference shares are more than those on bonds but less than on equity share. In exceptional circumstances, when preference shares enjoy special tax shields, like in US, intercorporate holdings of preference shares get exemption on 80% of preference dividends. Required returns on such shares may even be marginally below those on bonds. Preference shares are a type of equity security that generally pay a fixed dividend to shareholders and have a preference over common shares in terms of dividends and liquidation preferences. The valuation of preference shares involves determining the present value of future expected cash flows to shareholders. One approach to valuing preference shares is to use the dividend discount model (DDM), which is similar to the discounted cash flow model used to value other types of securities. The DDM calculates the present value of future dividend payments by discounting them back to their present value using a required rate of return, which represents the minimum rate of return an investor expects to earn on their investment. The formula for DDM is present value equal to D upon R minus G. D is expected annual dividend payment in perpetuity. R is required rate of return on preference shares and G is the expected growth rate of dividends. The required rate of return is typically calculated based on the riskiness of the investment as well as the prevailing market interest rate. The expected growth of dividends may be estimated based on historical trends or future projections. For example, if a preference shares pays an annual dividend of rupees 2 and the required rate of return is 8% with no expected growth in dividends, the present value of the preference share would be present value equal to 2, which is the D divided by R minus G. R is 8%, that is 0.08, and as there is no expected growth, it is 0. 2 divided 0.08, that is rupees 25. This means that the preference share should be valued at rupees 25 in the current market. Here, rupees is not written. You may take it in any currency, rupees, dollar, pound, etc. It is important to note that there are other methods of valuing preference shares, and the appropriate method may depend on the specific characteristics of the security and the preference shares of the investor. Additionally, market conditions and investor sentiments can also impact the valuation of preference shares. Perpetuity. Since dividends from preference shares are assumed to be perpetual payments, the intrinsic value of such shares will be estimated from the following equation valid for perpetuity in general. VP, that is the value of perpetuity today, equal to C, that is the constant annual payment to be received or coupon rate. C divided by 1 plus KP raised to 1 because it is the first year, plus C divided by 1 plus KP raised to 2 because it is the second year, and so on. C upon 1 plus Kp raised to n, it is equal to C upon Kp, and Kp is the required rate of return appropriate for the perpetuity. You have only to substitute preference dividend for C and the appropriate required return for KPS for KP and obtain the following equation: VPS, present value, equal to D upon KPS. You may note that D is perpetuity and is known as fixed forever. A perpetuity does not involve present value calculations, and the equation provides for computing any of the three variables, namely value of perpetuity, BPS, preference dividend, ID, required rate of return, KPS. Only if the remaining two variables are known, thus the value of a preference share can be calculated if the dividend per share and the required rate of return are known. Similarly, the required rate of return or yield can be known if the value of perpetuity and dividend per share are known. Means out of three variables, if we know two, the third may be calculated. Now, valuation of equity shares. Valuing equity involves determining the fair market value of a company's ownership interest, which represents the residual claim on the company's assets after all other claims such as debt and preference shares have been satisfied. Equity valuation is important for investors, analysts, and other stakeholders in evaluating the potential returns and risk associated with investing in a particular company. There are various methods for valuation of equity shares. Number one, price to earning ratio. This approach compares a company's current market price per share to its earning per share. A higher PE ratio typically suggests that investors are willing to pay a premium for the company's expected future earnings growth. Number two, price to book value ratio. This approach compares a company's market price per share to its book value per share, which represents the value of its assets minus liabilities. A lower price to book ratio may suggest that the company is undervalued relative to its assets. Number three, discounted cash flow analysis. This approach estimates the present value of a company's future cash flow, using a discount rate that reflects the time value of money and the risk associated with the investment. The DCF model requires detailed projections of the company's future cash flows, which can be challenging to estimate accurately. Number four, dividend discount model. This approach estimates the present value of a company's future dividend payments using a discount rate that reflects the time value of money and the risk associated with the investment. The DDM assumes that dividends are paid out to investors and therefore may not be suitable for companies that do not pay dividends. Comparable company analysis (CCA). This approach compares a company's valuation multiples, such as price earning ratio and price book value ratios, to those of other similar companies in the same industry or market. The CCA comparable company analysis assumes that the market price of similar companies are indicative of the fair value of the company being analyzed. Each of these approaches has its strengths and weaknesses, and the appropriate method may depend on the specific characteristics of the company and the preferences of the investor. Additionally, market conditions and investor sentiment can also impact the valuation of equity. It is important to note that equity valuation is not an exact science and involves a certain degree of subjectivity and uncertainty. Now, price earning approach. The price earning approach is a method of valuing equity securities that compares the price of a stock to its earning per share. The PE ratio is calculated by dividing the current stock price by the EPS. The PE ratio provides an indication of the market's perception of the company's growth prospects and profitability. A high PE ratio may indicate that the market expects the company to experience a strong growth in the future, while a low PE ratio may indicate that the market has lower expectation for future growth. The PE ratio can be used to compare a company's valuation to its peers or to the broader market. However, it is important to note that the PE ratio should not be used in isolation to make investment decisions, as it can be influenced by a variety of factors, such as changes in interest rate, inflation, and industry trends. Additionally, the PE ratio may not be appropriate for companies with volatile or inconsistent earnings, as the ratio can fluctuate widely depending on the company's earning performance. The PE approach can provide a useful framework for valuing a stock based on their earnings performance and growth prospects, but it should be used in conjunction with other valuation methods and careful analysis of the company's financial performance and prospects. According to this method, the future price of an equity is calculated by multiplying the PE ratio by the expected EPS. Thus, P equal to EPS into PE ratio. The PE ratio or multiple is an important ratio frequently used by analysts in determining the value of a share. It is frequently reported in the financial press and widely quoted in the investment community. In India too, you could verify its popularity by looking at various financial magazines or newspapers. The PE ratio essentially reflects the amount that the shareholders are willing to pay for every rupee of earnings. As such, It should reflect the risk associated with the earnings. For instance, if the PE ratio is 5 for a company and 10 for another company, then investor perceive that the risk associated with the earnings of first company is relatively higher than risk associated with the earnings of second company. That is the reason if you examine the PE of firms in the market, you will observe that PE of multinational companies are much higher than the Indian firms. The inverse of profit earning ratio is equal to capitalization rate. For instance, if the PE is 5, it means the market is willing to capitalize the earnings by 20%. As in DDM, the PE model also fails to consider the future potentials of earnings of the company since growth rate of earning is not deducted from the capitalization rate to get the value of the firm. For instance, in the above example, we find that EPS is discounted at 20% to get the value without considering any growth rate in the earnings. If the EPS is expected to grow at 5% in the future, the discounting rate should be 15%. But there is no provision for such adjustment under the PE model. Now, portfolio management, second part of today's counseling. In this portfolio management, first we are talking of portfolio analysis. Portfolio analysis is a process of evaluating a group of financial assets or investment known as portfolio to determine their risk and return characteristics. The goal of portfolio analysis is to construct an efficient portfolio that balances the risk and rewards of different investments. Portfolio analyzing their performance and risk, determining their correlation with one another, and constructing a portfolio that maximizes returns while minimizing risk. This process can be conducted using a variety of methods and tools such as statistical models, optimization algorithms, and risk management strategies. Need for portfolio. Portfolios serve several important purposes for investors. Here are some of the key reasons why portfolios are necessary. Number one, diversification. Portfolios allow investors to diversify their investment, spreading their money across different asset classes, sectors, and geographic regions. This reduces the overall risk of the portfolio and helps to ensure that no single investment has too much influence on the overall performance. Number two, risk management. By analyzing the risk associated with each investment in a portfolio, investors can manage their risk exposure more effectively. They can identify investments with high levels of volatility and make adjustment to the portfolio to reduce overall risk. Number three, return maximization. Portfolios can be constructed to maximize return based on an investor's risk tolerance and investment goals. By combining different assets with varying risk and return characteristics, investor can aim for a portfolio that generates the highest possible returns for a given level of risk. Number four, monitoring and tracking. By regularly reviewing the performance of a portfolio, investors can ensure that their investments are meeting their expectations and adjust their strategy as needed. This can help investors stay on track to meet their financial goals over the long term. Number five, flexibility. Portfolios offer investors a flexible way to manage their investment. They can adjust the composition of their portfolio as their financial circumstances or investment goals change, and they can also use different types of investment to achieve specific objectives. The portfolios are essential for investors who want to manage their investment effectively, minimize risk, and achieve their financial goals over the long term. Risk and return. Any investment decision require an estimate of return and risk associated with the investment. However, the most difficult task of investment decision is estimation of return and risk. If we are able to estimate a range of expected return, then it is possible to estimate the probabilities associated with the range of expected return to get the risk measure. In practice, however, the return and risk of the securities are estimated based on the historical return and risk of securities. A stock single period basic return is the formula is total return equal to dividend plus market price T minus market price T minus 1. Market price of the current period minus market price of the previous period and divided by market price T minus 1 or of the previous period. There are different measures of historical return. The most elementary form of return measure is holding period or return, yield or return. Here the dividend received during the holding period is added along with the capital gain and divided by the purchase price. If the holding period is more or less than 1 year, normally the holding period return is stated for 1 year. This measure is not much useful if one wants to measure the risk associated with the security. There are two other measures of return by which one can measure risk. Arithmetic average. The arithmetic average return is equal to sum of returns of period divided by n. For instance, if the stock has offered a holding period return of 11% in period 1, 12% in period 2, and 16% in period 3, then the arithmetic average return is equal to 13%. How? The total of 11 plus 12 plus 16 equal to 39 divided by 3 periods, number of periods 3, it comes to 13%. Though it is better than holding period return, this measure suffers because of its failure in considering time value of money. Another problem of this measure is differential treatment of positive and negative return. To cure this anomaly, we use geometric average. The geometric average return is based on the compound value and is also called time-weighted average return. It addresses the problem of differential treatment of positive and negative return described above. We calculate geometric average by multiplying and finding the nth root of the result. For example, in the last example, We can calculate geometric average by multiplying 11, 12, and 16, and whatever is the result of this multiplication, we will find out the third root, because the number of period is 3, the third root or root of that result, and it will be geometric average. In addition to the above two types of return, a foreign investor or foreign fund would compute dollar weighted return to adjust differences in the foreign exchanges between the point of investment and sale. For example, if a foreign fund purchases stock at rupees 80 today, when the US dollar rupee rate is rupees 80 per US dollar, and sold the stock at rupees 85 at the end of 1 year, the holding period return of rupee term is 7.5%, which is calculated finding out difference of 85 and 80, that is 5, and divided by rupees 80, 5 upon 80, it comes 7.75, that is 7.5%. However, if the rupee depreciate during this period and quotes rupees 86 per US dollar, the foreign fund incurs a loss because it can get less than $1 with the sale value of the stock. The loss is equal to 1.16%. This is calculated $1 minus 85 upon 86. It comes to 1.16%. Statistical measure of this. Let us now discuss the statistical measures of this. There are two types of statistical measures. They are standard deviation. We have just discussed arithmetic average. Standard deviation is calculated by finding the summation of the differences from the arithmetic average and then dividing it by n and again finding out the root of that figure. For example, in this example, our arithmetic mean was 13. Difference of 11 is -2. Difference of 12 is -1. -2, -1, and here +3. The summation is 0. And therefore, the standard deviation of this will be 0. Coefficient of variation. Coefficient of variation is calculated standard deviation divided by arithmetic average and multiplied by 100. Expected risk and return from a portfolio. The return on a portfolio of assets is simply a weighted average of the return on the individual assets. The weight applied to each return is the fraction of the portfolio invested in that assets. To illustrate, let us consider a portfolio of two equity shares A and B. The expected return on A is say 15% and that on B is 20%. Further assume that we have invested 40% of our fund in share A and the remaining 60% in share B. Then the expected portfolio return will be 40% means 0.40 multiplied by 15. If we calculate it, it will be 6 plus 60%, 0.6 multiplied by 20. If we calculate it, it is 12. 6.40 into 15, 12.60 into 20, and this total of 6 plus 12 is 18% is the expected portfolio return. It may be noted here that the portfolio weight can be either positive or negative. In case of securities, the weight will be negative when investor enters into short sales. Usually the investors buy securities first and sell them later. But with a short sale, this process is reversed. The investors sell first the securities that they do not possess and buy them later to cover the sales. Having discussed the computation of expected portfolio return, we now turn to the measurement of variance of portfolio's return. That is the risk of the portfolio. As mentioned earlier, assets when combined may have a greater or lesser risk than the sum of their component risk. This fact arises from the degree to which the returns of individual assets move together or interact. It is vital, therefore, to consider covariance of returns in estimating portfolio variance. Let us intuitively understand why the risk of portfolio of stocks is lower than the sum of the risk of the individual stock. Suppose you have invested your wealth in two securities. Assume the securities prices move in opposite direction such that one security gains, the other security incurs losses. For instance, if one security reports a gain of 10% in a period, the other one reports a loss of 5%. In the next period, the security which lost 5% shows a gain of 12%, but the other one lost by 7%. Though the two securities individually has a variance, an investment of equal amount in these two securities will have a constant return of 5% during the periods. Here, 10 minus 5 is 5 and 12 minus 7 is again 5. Therefore, a constant return of 5%. In other words, the variance of the portfolio return is 0. Portfolio analysis. We have discussed that risk is associated when the portfolio includes one more stock in the portfolio. The above observation is not universal in a sense that if the new stock is perfectly correlated with other securities in the portfolio. In other words, the job of investment analysis or any other person responsible in constructing the portfolio is to identify stocks or securities that are less related with each other for portfolio construction. The risk of portfolio can be reduced to 0 if the correlation between the assets included in the portfolio is equal to -1. However, such securities are difficult to identify in the market. If two securities are perfectly correlated, then there is no diversification benefit and such combination will not reduce the risk of the portfolio. There are only very few securities in the market whose correlation is equal to -1. What is more prevalent in the market is securities whose returns are correlated between -1 to +1 depending on the level of correlation. Diversification reduces the risk of the portfolio. Portfolio selection. We have that combination of securities which normally reduces the risk. Often, it also leads to an increase in return, which is good for investors. That is, you are able to achieve higher return and also lower risk through diversification. The problem is, if there are large number of securities in the market, how to determine the optimum portfolio, which reduces the risk while keeping the return constant or increasing the return. Steps in portfolio selection. Portfolio selection is the process of constructing an investment portfolio by selecting a mix of assets that is expected to achieve a specific investment objective. Given investors' risk tolerance and investment horizon, the steps in portfolio selections are as follows. Number one, define investment objective. The first step in portfolio selection is to define the investment objectives. This involves determining the investor's goals, risk tolerance, investment horizon, and other investment preferences. Number two, identify available assets. The next step is to identify the available assets that can be included in the portfolio. This involves researching various investment options such as stock, bonds, mutual funds, exchange traded funds, real estate, commodities, and alternative investments. Number three, assess assets classes. The next step is to assess the potential risk and return of the different assets classes. This involves analyzing historical performance data, evaluating the economic and market trends, and considering other relevant factors that may affect the future performance of the assets. Number four, determining assets allocation. Once the investor has identified the available assets and assessed their potential risk and return, the next step is to determine the optimal assets allocation. This involves deciding how much of the portfolio should be invested in each asset class based on the investor's risk tolerance and investment objectives. Number five, select a specific investment. After determining the assets allocation, the next step is to select a specific investment within each asset class. This involves evaluating individual securities or funds, considering factors such as management quality, performance history, fees, and expenses, and other relevant factors. Number six, monitor and rebalance. Finally, once the portfolio has been constructed, the investors should regularly monitor the performance of the investment and make adjustment as necessary to maintain the desired assets allocation. This may involve rebalancing the portfolio periodically to ensure that it remains aligned with the investor's investment objectives and risk tolerance. Now, the next part of today's counseling, portfolio selection. One minute, please. Sorry. Portfolio selection is the process of constructing an investment portfolio that maximizes returns while minimizing risk. It involves selecting a combination of assets that have different levels of expected returns, risk, and correlation with each other. The goal of portfolio selection is to find the optimal mix of assets that provides the highest expected return for a given level of risk or the lowest risk for a given level of expected return. The concept of portfolio selection was first introduced by Henry Markovich in 1952 in his seminal paper Portfolio Selection. Markovich showed that investors can reduce risk by diversifying their investment across multiple assets rather than investing in a single asset. He developed the concept of the efficient frontier, which is a set of optimal portfolios that offer the highest expected return for a given level of risk or the lowest risk for a given level of expected return. We have learned that an investor's opportunity set of investments or portfolios will be defined by the efficient set. But we left the question of actually finding the efficient set unanswered. This unit will first provide a logical approach to delineating efficient set. We will then discuss some of the practical problems of implementing this approach and present another model known as single index model that simplifies the portfolio selection process to a great extent. Finally, we will indicate some other portfolio selection techniques. Risk and investor preference are two important concepts in the world of finance and investing. Risk refers to the uncertainty or variability of returns associated with an investment. Investment preference refers to the particular set of preferences, beliefs, and attitudes that an individual investor has towards risk and return. Different investors have different preferences when it comes to risk. Some investors are risk averse and prefer investment that have lower level of risk, even if it means accepting lower returns. Other investors are more risk tolerant and are willing to accept higher levels of risk in order to potentially earn higher returns. Investor preference can also be influenced by factors such as age, financial goal, and investment horizon. For example, a young investor with a long investment horizon may be more willing to take on higher levels of risk in order to potentially earn higher returns, while an older investor approaching retirement may be more concerned with preserving their capital and may therefore prefer investment with lower level of risk. Ultimately, an investor's preference for a risk is a highly personal decision that should take into account their individual financial situation, investment goals, and personal beliefs. It is important for investors to have a clear understanding of their risk tolerance and to carefully consider the potential risks and rewards associated with any investment before making a decision. Generating efficient frontiers. The efficient frontier is a set of optimal portfolios that offer the highest expected return for a given level of risk or the lowest risk for a given level of expected return. It can be generated using the following steps. Number one, define the universe of assets. The first step is to define the universe of assets that will be included in the analysis. This can include a stock, bonds, commodities, and other assets. Number two, collect historical data. Collect historical data for the selected assets, including their returns, volatility, and correlations. This data will be used to calculate expected returns and risk for each asset and to create a correlation matrix. Number three, calculate expected return. Use historical data to calculate the expected returns for each asset. This can be done using various methods such as the mean return or the capital assets pricing model. Number four, calculate risk. Calculate the risk for each asset using historical data. This can be done using various measures of risk such as standard deviation or beta. Number 5, generate portfolio combinations. Generate portfolio combinations by combining different assets in different proportions. This can be done using a portfolio optimization tool or manually by selecting weights for each asset. Number 6, calculate portfolio expected return and risk. For each portfolio combination using the expected returns and risk of the individual assets and the correlation matrix. Number 7, plot the efficient frontier. Plot the efficient frontier by graphing the expected return versus the risk for each portfolio that offer portfolio combination. The efficient frontier will be the set of portfolios that offer the highest expected return for a given level of risk or the lowest risk for a given level of expected return. Number 8, select the optimal portfolio. Finally, select the optimal portfolios from the efficient frontier based on your risk tolerance and investment objectives. Generating an efficient frontier involves a complex analysis of historical data and requires a deep understanding of portfolio theory and optimizing techniques. Efficient set. An efficient set is a continuous curve, which in turn means that there are infinite number of efficient portfolios. This poses a typical problem to the investors. How can one determine the composition, that is combination of assets and portfolios weight of each of an infinite number of efficient portfolios? Markowitz did contemplate this problem and in a major breakthrough present a solution algorithm based on quadratic programming technique. Constrained minimization problem. As we know, an efficient set can be determined by minimizing portfolio risk, that is return variance for any level of expected return. If we specify the return at some level and minimize risk, we have one point, that is a portfolio on the efficient frontier. Limitation of Markowitz approach. It is easy to see that the Markowitz approach to trace efficient set is extremely demanding in its input data needs and computation requirements. This has been probably best expressed by Markowitz himself. It is reasonable to ask security analysts to summarize their researches in 100 carefully considered variants of returns. It is not reasonable, however, to ask for almost 5,000 carefully and individually considered covariances. Indeed, while analysts and portfolio managers are accustomed to thinking about expected rates of return, they are much less comfortable in assessing the possible ranges of variation in their expectations and are usually not at all accustomed to estimating covariance of returns among assets. The problem is made more complex by the number of estimates of covariance or correlation required. For a set of 200 shares, for example, we need to compute 200 multiplied by 200 minus 1 divided by 2. That is a formula of combinations. 19,900 covariance. It is unlikely that the analysts will be able to directly estimate such a staggering number of inputs. Obviously, what we need is an alternate formula for portfolio variance that lends itself to easy computation even when we are dealing with a large set of assets. However, an understanding of Markovitch process would sharpen your understanding on the portfolio theory and management, though you may not use in your day-to-day life Markovitch method of portfolio construction for stocks. Sharp's simple index model. We get such a great capability with the single index model developed by a student of Markovitch named William Sharp, 1963. In the 1950s, after techniques for estimating the required inputs to this model were perfected, packaged, and marketed as computer software, modern portfolio really took off in terms of practical application. Now the single index model is widely employed to allocate investment in the portfolio between individual equity shares. While the original more general model of Markovitch is widely used to allocate investment between types of assets such as bonds, shares, and real estate, in the discussion that follows, we present the basic tenets of the single index model with reference to investment in equity shares. The assumptions and the model. Essentially, the single index model assumes that the returns of various securities are related only through common relationship with some basic underlying factor. In the words of Sharp, this factor may be the level of the stock market as a whole, the gross national product, some price index, or any other factor thought to be the most important single influence on the returns from securities. A casual observation of share price movements at least tend to support this line of argument. There is considerable evidence that when the stock market goes down, most shares tend to decrease in price. For instance, on the date of budget, several stocks move in the same direction depending on the assessment of budget on the economy and industry. It appears, therefore, that one reason share returns might be correlated is because of a common response to market changes as measured by the movements in, say, share price index. Other portfolio selection models. So far, we have considered investment in risky assets like equities. However, an investor can also invest in risk-free assets such as treasury bills or government securities. Besides, in our analysis, the investor is not allowed to use borrowed money to invest in a portfolio of assets. This means that the investor is not allowed to use financial leverage. If we take into account these new opportunities to the investor, we will notice a major impact on the shape and location of the efficient set. We now take a note of some other portfolio selection models that seem to hold great promises to practical application. One such model is the multi-index model. There are different variants of this model, and each of them is developed to capture some of the non-market influences that cause shares to move together. The non-market influences, in essence, include a set of economic factors or industry characteristics that account for common movement in share prices. While it is easy to find a set of indices that are associated with non-market effect over any period of time, it is quite another matter to find a set that is successful in protecting covariance that are not market related. There is still a great deal of work to be done before multi-index model consistently outperform the simpler one. Another model that takes into account a wide spectrum of practical consideration in portfolio selection is the goal programming model. In real life, an investor's goals and desires transcend the notion of a trade-off between only risk and return. For example, an investor may prefer to invest some minimum amount in several different shares, but at the same time, he or she may not like individual investment to exceed a specific limit. Additionally, she or he may prefer dividend income to capital appreciation. There may also be a desire not to allow the portfolio beta to be either above or below a predetermined level. Apart from holding such diverse goals and desires, the investor may even set the order of their priorities. In this kind of investment problem situation, the programming model is ideally suited to provide an optimal solution. Further goal programming solution can be usually obtained by available computer packages. I think it is almost over. Time is over. That's all. Namaskar.
थोड़ा सा टाइम देना ऑफिस से बंद करने के लिए।
अच्छा।
ऑफिस अपना